Hi, everybody, and welcome back to Dublin Tech Talks. On our podcast today, we have Brian Fahey, who is CEO of MyComplianceOffice. Welcome to the show, Brian.
Thank you very much for having me on.
So MyCompliance is a compliance management software platform that helps financial services unify their activities across conduit and regulatory compliance. A regular now on the Deloitte Fast 50, winning the Scale Up Award in 22. Things are looking great for the business. I know it's a well-established business to this stage, and securing the debt financing last year, I say, is going to help the business push on. Really nice to meet you, and thanks for coming onto the show. Do you want to give us a bit more detail about what the business is and what it does?
Yeah, sure. Effectively, it's B2B software for capital markets firms. And capital markets firms means if you divide financial services into three groups, what most people think of as banks, insurance companies, and capital markets, sort of investment banking. It's sort of where the bigger money flows through. And in the capital markets industry, there's a lot of money involved in a lot of transactions, and it's a place where there's a lot of regulatory focus of financial services entities around the world. And we do a range of software modules on one single integrated multi-tenant SaaS platform for global firms around the world. And we do it for very, very large financial services entities and down to much smaller ones around the main highly regulated jurisdictions around the world.
Regtech is just something I'm actually quite interested in. I don't know why, but yeah, no, it's and Ireland seems to be quite a hub for it as well. Is there a reason for that, or is it just the kind of where people kind of finance has been quite heavy and it's just kind of brought along that entrepreneurial person to really kind of look at what the business is or what the business does and just kind of go from there?
It has become a bit of a hotbed the last 10 years in Ireland in particular. I mean, we're around a little longer than that. We started in 2008 as a spin-off from actually Fidelity Investments Offshore Development Group in Ireland. And probably like a lot of things and how things go, my own background had been professional services in technology for capital markets firms in the US. I spent about 15 years in the US, and I came back and I joined Fidelity Investments Offshore Development Group in Ireland. And we were taking Fidelity Investments technology and selling them into the UK and Ireland. But we actually then strived and asked to become a product company within Fidelity. And we really were just casting around what's hot, what's interesting. And it was compliance was the topic even back then in 2006, pre-crisis, that is, a big demand for capital markets entities. So that's how we kind of ended up picking it. I had supported compliance systems in my whole career for cap markets entities, but they were, kind of like where you ended up if you were, getting the wrong end of a stick on some sort of roles as well. It was a poor cousin to everything else that went on, but it started to change back then. And I think what's happened for Ireland and regtech is, there's big opportunity in it. It's the whole focus and regulatory enforcement around the world has changed very significantly in the last 15 years. And then people went where the opportunity was, and the capital that was around has gone to where that money is. And so, compliance software, or even the more broadly termed GRC, governance, risk and compliance software, has been receiving a lot of capital investment around the world for about 15, 20 years. So I think, Ireland is getting its probably undue share of it, but that's probably related to support and other factors that certainly benefited us in our tailwinds.
So you kind of, the business kind of took off post bank crisis and as it went from there. Was it just speak to a lot of people that kind of form businesses and go from there? Was it just right time, right place, right product? Or was there a bit of luck in it? Or how did it kind of get that first kind of iteration of what the product was?
Well, there's always luck in it, but I wouldn't say we had our most successful time after the crisis. We actually had the worst time after the crisis. Funnily enough, like everybody's journey is a little different, but in our case, I've always wanted to run a business, and I've always wanted to build a software business and been involved in it, and always was just waiting for the right kind of opportunity. And it was a situation where, although we were within Fidelity Investments and we had this concept and they helped us initiate all of it, and actually IDA provided actually an R&D grant to Fidelity to help sort of investigate this opportunity back in the day. I really was we were bad fit for Fidelity in what we were doing for a combination of reasons. And I took the opportunity to ask them to lift it out. And so that was how we initiated getting as a separate Irish entity out of course, an FDI institution like Fidelity and an R&D grant that the IDA at the time were willing to provide. So that was how we initiated it, and it was luck and I suppose happenstance and a bit of taking the opportunity when it's there in front of you. But we had a very tough time actually. The first 5 years were a very different kind of a place to set up a business than it is now. Financial crisis meant that, and the way Ireland was at that time, there was very little capital available to anybody. And so the capital challenges there, I mean, we were getting offered maybe, 200,000 euro for 25% of the firm. That's the kind of money that was available. If we went to the US then, at that time, they were saying, there's no money available here for a company of your size. You need to get it locally. So we were bootstrapped for the first 4 to 5 years. And the product we originally built, same old classic story, it actually wasn't really fit for the market. If I had to give one piece of advice for somebody, we had, because it was Fidelity who do things in a big way, they did market research, or we did market research. And we got a lot of people saying, we would love to have what you built. That would be fantastic. We'd love to get that. And in the end, of course, we forgot to ask one very, very important question. Will you get budget for this? In a B2B environment, there's often a 12-month budgetary cycle, and you've got to say, will you be able to get money for it? Because the difference was, when we built a great product, there wasn't a demand for it really that would actually, the clients would have wanted it, but they wouldn't have got budget for it. So we changed in 2009 what we were offering to something more in a particular area of what we would call now employee compliance. So we barely survived. We had the classic story of, our fingernails are on the walls of survival for the first 5 years, the classic story around all of that. So we had a tough time the first 5 years. And
as well, that classic story of we have a really nice product, but nobody to buy it. I've heard that a few times.
Yeah, I'm sure. But that, particularly the one question, and it was just the difference between we would want to have it versus the willingness to be able to pay for it.
So post kind of 09, 10, 11, that time, was there a pivot in the sales function, or was it a pivot in just what you did and how you got the product to market?
We changed the product in 2009. We actually built a new product effectively on our platform. And that was something that we had learned in the previous year and a half, that was in demand. It naturally was something that fitted well for a multi-tenant SaaS product. We did the classic business model of, building sort of a capable core product and selling it at a much cheaper price. And we're replacing manual systems that meant manual spreadsheets and different ways of doing something that was already a regulatory rule. So it was leveraging off, cloud computing, multi-tenant SaaS, much lower implementation cost, much lower annual fee cost to do that, and we sold it in. But we were selling into the US. That was the primary market always from the start. Today we're about 1,500 customers, and maybe 5 of them are Irish, to be honest. That's really all it is. So, but the US has always been our primary market. And but those 5 years, we would have been 6th in the market. There were a number of other firms, quite a few doing multi-tenant SaaS, the same thing. So we were a distant 6th behind, I think, all the major players. Very different today. But.
Yeah. And why was America first? Was that just what you were comfortable with from where you were in Fidelity, or because a lot of Irish companies would focus, say, Ireland first and then elsewhere? Or was it just not the market here?
Well, there certainly isn't the market here. And I think for an awful lot of B2B software, I would be always advocating you got to start. It's hard enough to build a business. Start where the market is big.
Yeah.
And you'll have as much pain in trying to do it in a small market as in a big market. So go for the big market. Capital markets, the investment industry, or whichever way you want to call it, is very, very established in the US. When you have these pension plans that people define where their money goes, they get used to investing earlier. It's happened in the US for a long time. UK, Australia has had these pension plans, and they bring forth a broader set of investors. And of course, there's more money in there. So it actually is different. There's like 15,000 what we would call registered investment advisory and broker-dealer firms in the US. And you'd be talking about 20 in Ireland.
Okay.
And in the UK, you might still only be talking about 500. So you really have to, it's really a simple case of go where the biggest market is.
Yeah, no, definitely. Go, who's got to give you money? So the business has kind of scaled quite gradually, and then over the last few years, it's kind of multiplied and people anyway, and kind of, I'm guessing, customers and clients. As CEO, how have you found that scale journey, and kind of is it something that you've enjoyed, or is it something that keeps you up at night?
Well, it's the biggest thing, I think, for anybody who's built something from scratch. What you do with it when it gets to a reasonable size. I mean, do you want to do something else? Do you want to be in a different business, or do you want to go into and build a scaled business? Certainly, I fall into the latter, but it's a very different type of skill sets to do that. And all of us across the whole firm and all the group that were with us from the start, we've all had to change and evolve with time. But it's been in spurts in terms of the scaling, the real big scaling. For the most part, it's been very steady growth year after year. We charge on an annual basis. We end up with our, what they call the annual recurring revenue, is the same number as our revenue from the year before. So we've already got the revenue from the year before backed in. So you can now invest into you decide where you're doing your investment. And we used to, in the second phase, the second 5 years, if you like, we were, all right, we don't have enough in support. We don't have enough in sales and marketing. We'd sort of put chunks at a time more into the functions to try and grow them and scale them. And that's how it grew for the second 5 years. The last 5 years, we changed our focus a lot to focus on the much larger entities. And that has been a big source of our growth the last 5 years. The product has become, and we've also been able to, each year we can invest more in, and we've been able to add a lot more products. So the bigger scale has come in the last 3 years. I mean, we actually we more than doubled our team in 1 year, and a lot of it is in product development. But we would actually expect that to then bring forward new products over the next 3 to 5 years that will also mean more scaling of the rest of the firm. So the scaling that the heavy scaling we've done the last 18 months to a year is actually an investment for the future, really, in product development. And right now we're going to be at our highest percent ever of R&D, or product investment, at 33% of our revenue. So we've a long-term view and a long-term goals in around what we're building for the industry. And so I think our scaling journey is only starting, to be honest. But it'll be a journey, that's for sure. And it'll be a journey for myself, the management team, and the whole organization. And, you got to continually challenge yourself about it, and you got to continually try to learn, because it's a different capability, different level of way of working.
And the evolution of the product, I'm always interested in this. So you can tell me to stop asking questions. But is that customer led? Has that been just identifying new markets? What's the kind of either kind of you have to evolve or die, or what type of kind of mentality is the product development been pushed on? We've
had very ambitious vision, mission, whatever term you want to give to it, from early on, about what we want to do and build out. And the big difference for us is about a single integrated platform for doing the full range of GRC activities for cap markets on one platform. So it's primarily been growth into different products on the same platform. That's been primarily the growth. It has been geographical expansion into the jurisdictions that we believe we can sell in. And we went through years of where we go on these you go visit these different countries that Enterprise Ireland would arrange trips for, and you'd go and talk to Irish diaspora, and you'd kind of find out more about those individual markets. And with all of that, we very much focused on highly regulated markets, and we haven't changed that actually in the last 5 to 7 years. So where our kind of geographical focus is pretty set, and our growth primarily is coming from product expansion, plus that thing, what I mentioned in 2017 about actually going after larger entities. So you get growth from being able to service and support very large financial services, and there's a different, obviously, revenue that comes with that. So it's come from multiple places, but it's been sort of expand the geography this year to a different geography in different years, and then different products in different years, depending on where the demand is. So in the compliance world, I would say the demand is actually from enforcement. People think it's about the regulations. It's actually, for us, I would suggest it's actually all about the enforcement. Where is there going to be enforcement? Because not everybody is compliant anyway until they have fear.
Yeah,
there's a lot of it. So.
Until you're told, are you compliant? Yeah, of course we are.
Well, being told isn't enough. Being told is actually not enough unless you're being monitored. I always remember when I left Ireland originally, and I said, well, in the US, and when I left Dublin, I always kind of used to remember, like, people would park everywhere and they'd be up on the double yellow lines and all this kind of stuff. And at one point between that and coming back, the Garda would be doing enforcement, and there'd be actually tickets and fines and all that. And all of a sudden, people aren't parking on yellow lines. And it's amazing to see how consistent that happens. When I mentioned what we had in 2009 and what the market we chased in 2009, that wasn't any new regulation. That regulation had been around for a while. The difference was the enforcement. And the new products that we created very often were in reaction to somebody getting fined and people being worried about it. So without enforcement, rules mean nothing, for a lot of people.
Yeah, no, 100%. Banks didn't think you'd get fined for the tracker mortgages. Suddenly it is. Now it's an important part of that's the reality. I never thought of it like that.
But it's so core and key to our business. At the end of the day, we're growing quite well. We're expanding in our target segments, if you like. But the world of compliance is getting dramatically bigger and more opportunity with it, because the enforcement levels have changed very dramatically. And this is a learning that the regulators came about, I'm going to guess, maybe 5 years. It depends on the regulator, but they used to have fines before, and basically it used to be a write-off for the companies, and they would say, it's better off doing what we're doing. That fine is better off paying that than dealing with that. So they woke up to that fact, and they made some really, really big fines, which turned heads around.
Especially in America, where the regulator is so powerful, and they've overarching or kind of authority over the majority of finance houses as well. You don't want to cross their paths too many times.
Yeah, but it's changing around the world as well, and you can even see, think about it in Ireland in the context there, and as you say, the fines on tracker mortgages, and those amounts are become very meaningful at a board level at these financial services institutions. And they will be saying, okay, that is real. We better not get caught like this again.
When it comes to board level, it's gone. You're doing something right. You mentioned there as well in previous that you've based yourself in America a bit and back in Ireland. What would you say the ecosystem for an entrepreneur or even doing business compares now to probably when you left, and what it feels like in America? I'm always really interested in that.
Well, the biggest difference for an Irish tech company today is the access to capital. I mean, and that is hugely, hugely different. I mentioned about it earlier on. I think the other big difference, and it's a difference to us as a firm, there's a sort of a natural progression these days, it seems, with any tech entity, not just in Ireland, but around the world. It's VC money, it's Series A, Series B, Series C. Once you get to a certain size, you sell it to a PE firm. You grow it to another size during that fund, and it's another 3 to 5 year cycle. And they sell it to another PE firm, and valuations get higher, but the valuations are only there as long as there's another PE firm. The old traditional approach of building a great solution, great product, great market, and growing it over time, for the same person, same business person or same entrepreneur, that doesn't exist in the same way anymore. And it's driven by the amount of capital that's actually that's available for funds, VC and primarily private equity. I mean, the influx of capital is ginormous in the last 15 years, and regtech is getting its fair share of that for sure. So I think, the entrepreneur or tech company builder, it's a different model. I mean, there's a whole focus that has got to get spent on preparing for the next investment round, whereas we didn't have that option. So we actually just had to kind of build it and bootstrap it and, get to break even and try and stay at break even and make sure we didn't run out of money.
And is that why you went with the debt financing option, or you just felt more comfortable in that space?
Yeah, well, there's a bigger story in that. When we were in those first 5 years, we were in trouble, and we got into trouble trying to build out the product. And so we ended up getting some friends and family money in 2012, and we won our 2 biggest deals as well. And we'd actually had an offer on the table that was pretty small money for the company that we thought we would have to take just to survive. And it really was just going to pay back some debt, really. And but we got some friends and family money, and we got a couple of $100,000. You're only talking about a couple of $100,000 euro. And then I said won 2 big deals in the US and managed to get through to break even. So in actual fact, the first set of debt financing we took a couple of years ago was actually to repay the friends and family money. And that's where that came from. And they wanted to have a charge over the shares to do it. And so ended up taking out all the friends and family money because they wanted to get some money back from it. So that's where it started. And then a key opportunity came up to buy a company that was a competitor of ours. And it was very much an opportunity to acquire a lot of clients in our space. And it becomes much more of a financial return to the company over time, and the debt financing worked out less expensive. And it's gone up in cost a little bit since, but there was a little bit of I've worked so hard to retain this equity over this last number of years, and do I want to give it up now? So that was part of it. It's not that I'm totally against that, and at some point we'll take more capital to get to the growth we want. But at the time, it was better just to do the venture debt for us.
It's very hard to give away equity. You work so hard to get it.
Well, and the difference was, most of our growth, which has been organic product build and organic sales and marketing, we've been able to finance ourselves for the last 10 years. So we'll see. We'll see where the world works out. There's a lot of opportunities out there, and we have a long way to go to get to where we want to be. So
definitely. I won't take much more of your time, Brian. Last couple of questions. The future of the business. You've obviously product development and iteration. The next 12, 24 months is going to be exciting for the business. You obviously have goals and where you want to get to. Is there what does success look like for you in the next few years?
Well, it is about the probably breadth of product sales is the key for us. And we are effectively sort of the original core market in 2009 built something out called employee compliance tools. And, in many of the major markets, that is maturing. And so effectively, it's kind of an old school set of portfolio of products that are at different levels of market maturity. But the real key is beyond building and finishing those additional components, we would have one single integrated suite. And I think that is market changing, as opposed to all individual solutions and again, when you're PE backed, you tend to buy companies, you end up with different technologies. They're all in different data silos. They're all quite separate entities. There's different cultures, and they have a 3 to 5 year cycle. We have a much more longer term view. So we don't look at it necessarily about 1 to 2 years. This is always a sort of where we're trying to go with the firm and the 3 to 5 year cycle around that. So we don't have the constraints of having an owner that needs to get their return in 3 to 5 years. So the 18-month time frame is about building more product, continuing our expansion, getting more clients. Beyond that, it's about having a very, very differentiated suite of tools for the marketplace.
Perfect. And last question, I promise. You've obviously grown a business. You've mentioned your ups and downs and the squeaky bum time, as Mr. Ferguson would say. What advice would you give to aspiring entrepreneurs or people or other business leaders that might find themselves in that position, or somebody who's looking to kind of get into the entrepreneurial world?
Well, as I said, one of the things I would repeat would be make sure that there's going to be money to buy what you want to do, what you do. I mean, as I said, the world has changed a bit because of all the way financing works and capital markets and the speed to market and capital, it has changed in that way. But, I favor building a great business with a long-term model. I mean, they say these days that you can't have competitive advantage anymore because the speed of capital can mean that people can copy and do whatever you do. I do think you still have to build good businesses with good culture and good fundamentals if you are doing it for the long term. If you're trying to do it for the short term, and I mean just sort of get to a sale, which is a lot of focus for a lot of people, then do try and hold on to the equity as much as you can. That is a key issue. And, but very often you're looking down the barrel of a gun of needing money to get to the next sort of set of investment. But I will say you can do a lot with a small group of great people that money won't do. Money, when you get it into a company and you tend to get it and it's supposed to spend it fast so that you get that rapid growth, that's what those fund people are looking for. There tends to be so much wastage in that. And you also are then tend to be attracted by these high-priced people. In the US market is full of them, and you can easily go through that money very, very quickly. And I'd say bear in mind how the VC and they want very, very rapid growth quickly. But that's not necessarily the best for you, the business, the people, your equity situation. I just bear that in mind is what I would say to people these days.
Brilliant advice, especially at the moment, the last 12 months of anything to show for. Brian Fahey, CEO of MyCompliance Office, thank you very much. And thanks, Camille, for your time, and I hope to see you soon.
Thank you very much.
Thank you for listening to our latest episode on Dublin Tech Talks. That was Brian Fahey, CEO of MyCompliance Office. Really interesting company born out of Fidelity Investments, really focusing on what they know well. Have really focused on their product evolution and really focused on what the customer is needing in the marketplace and really kind of, as you said at the end there, just making sure that you have the right people doing the right things and really trying to grow your revenue and getting to break-even point. It's a really interesting point. If that is of interest to you and you want to hear more, please subscribe to Dublin Tech Talks on our YouTube, Spotify, Apple, or wherever you get your podcasts. Talk to you soon. Thanks.